The second type of arbitrage I'm aware of is something called merger arbitrage. Now, to these merger deals, there are two types of offers that they can make. And the first simple one is an all cash deal. This is a very recent acquisition deal that just closed. They got a $4 billion buyout offer representing a $21 per share price. And as you can see, we had a very large jump up on the initial reaction to the offer. But again, because it's not confirmed, they have to go through all the hoops to get this deal approved. It'll trade just below. And that just below price is basically what an arbitrager would take advantage of. So say you got in here at $20.75 or whatever, right? Because you know the offer is going to close at $21, your profit would be that 25 cents. Now, for the all stock deals, and yes, there can be a combination of cash and stock, but I'm just going to make, for simplicity's sake, just the stock version. Now, if you watch the previous video, it'll make a lot of sense, but if you haven't, then you should probably go watch it, as well as subscribe, like this video, share it, and convince others to try to subscribe to my channel as well. But I'm going to illustrate this for you using the previous example because it's the best visual example out there for all stock deals. So in cases of all stock deals, they'll have something called an exchange ratio. In this case, it would be, let's say, a 0.5 for 1, meaning that for every 1 share of the selling company that you own, you're going to get a 0.5 share from the acquiring company. Now, the ideal scenario is you want the selling company to go up, like in the previous example with the all cash deals, you want it to go up to whatever the buyout price is, right? To kind of try to close a little bit of that spread. And you want the acquiring company to go down. And the reason why the acquiring company goes down is typically in all share deals, what they'll do is they'll print more shares. And you have watched my channel for a while, or if you're new or anything like that, the way they accomplish that is typically by printing shares, and that's usually seen as negative because they're diluting shares within their own company. How the strategy is usually run is you obviously buy the selling company down here, say for 100 shares or whatever, right? And then you would sell 50 shares of the acquiring company, because after the exchange ratio, because you're only getting 0.5 for every 1 full share you have of the selling company, you're going to be left with 50 shares. So you're going to be 50 shares short on this, you're going to be 100 shares long on this, and then when the deal closes, your profit will be whatever the net difference in between these two prices are. A lot of arbitragers like to say risk-free and all that sort of stuff, but this isn't without its risk either. For the all-cash deals, for example, if the deal falls through, the stock will fall back down to what's called the clean price, so whatever the price was before the offer was made. And this kind of goes the same way for the all-stock deal, where the company being acquired, their stock price will drop right back down to the clean price, similar to the all-cash deals. But the extra leg to these stock deals, which I personally don't like, but what'll happen is the acquiring company, because they're offering shares to buy this company, will suddenly jump right back up to their clean price. So you're basically losing on both ends for this thing. Outside of these mechanics, there are other fundamental mechanics that might actually screw you, such as the HSR rule, otherwise more commonly known as the anti-compete clause in America. Outside of the federal government, some of their federal agencies, such as for example, the FCC, could say something like, I don't know, they can't do this deal because something within this deal, if they merge, will cause subscriber access to our radio stations, television, broadcasting, whatever that sort of stuff, all their costs to rise, and therefore it'll pass on to consumers, bad for America, et cetera, right? And on top of this, you got the shareholder approval as well. Maybe the shareholders think that the company being acquired has something that the acquiring company wants, and they don't want to compete with them, so they can maybe not push through it. And on top of all this, there's also forward agencies. If you didn't know about the merger between Honeywell and I think it was General Electric, it was a German court that blocked the deal because there was some sort of anti-compete thing that they wanted. I don't remember. This was way before my time, but they blocked that deal, so GE never really merged with Honeywell. There's probably a multitude of other things that I'm failing to mention that could cause these deals to fall through. And, normally even I would ask is okay, why would I risk 30-40+% on something I'm only going to net yield around 1 to 5% on? And honestly, I don't have a full answer for you. Patrick Boyle actually has an answer for you somewhat. In one of the videos I watched, he said that the reason why they do this, a lot of hedge funds do this, is because they can acquire higher leverage. So obviously that 1 to 5% just gets expanded because they're triple, quadruple downing, whatever, that sort of thing in the ones that win, right? But also on top of that, they have a high hit rate, somewhere around the tune of 80%, which is it's pretty good, especially if you look at that distribution table of like, how much do you actually need to win in order to break even and so forth, whatever, right? And that, in the most broadest sense, is merger arb. It gets really complicated, and each deal is different. Stuff like the risk-free interest rate, calculating that. What is the interest rate on the all-cash deals? What is the dividend situation? How does earnings affect it? There's a lot of factors. Like, you could literally dedicate an entire career to basically doing something like this. At the end of the day, my goal is to kind of expose you to things that other creators are unaware of or just only ever scratch the surface of. It's kind of up to you also to use and adapt things where you see fit. Like, for example, with the first one, with the pure arbitrage, back in the day, you could have did that type of arbitrage with crypto because a lot of the exchanges heavily mispriced their crypto, and there was no centralized way of pricing things. It's how Sam Bankman-Fried actually made a lot of his money. And, these things and concepts can be applied outside of the stock market, such as like drop shipping, for example, and so forth, or whatever, right? Stuff like that is just tools within your arsenal, and you can obviously readapt it to certain different types of things. But, that's all I have to say for this video. The next video, I'm going to talk about triangular arbitrage. But for now, just remember, just because you're a day trader doesn't mean you have to trade every single day.